Welcome to the show, everybody. I am joined by two of my favorite chief investment officers. I have Rubin Miller of Perspective Wealth Partners and Phil Huber of Savant Wealth Management. Guys, thanks so much for joining me today.
Thank you, Peter.
So we're recording on January 4th, but by the time this gets published, I suspect all our clients will have their statements. I think it'd be interesting to hear what you guys think the most common questions will receive, what those will be, and how you think you'll answer them. Phil, let's start with you.
Yeah, I mean, I think nowadays most investors are looking at their statements or holdings online like more frequently than once a year. But let's just assume that they, look January 1st, 2022, and are now looking again. What's interesting about this year is in most years, it would depend on somebody's allocation. In other words, if it was a very good year, you'd expect the 80-20s to do significantly better than the 20-80 stock bond allocation folks, and vice versa in a down year. I think what's really interesting this year is that regardless of whether someone falls into the kind of conservative bucket, moderate, aggressive in terms of their overall asset allocation, they're kind of all in the same boat. Like I'm looking at a 20-80 portfolio last year was down 14%, and a 80-20 was down just about 17%. So pretty narrow spread. And that's, I think, the bigger surprises are certainly going to be for the folks that are more heavily tilted to bonds because they are used to a certain type of relationship between stocks and bonds. And that, I think everyone, if they're reading the news, are aware that stocks are in a bear market or entered a bear market in 2022. The natural assumption is, okay, well, my bonds are my ballast, my defense. And so probably very surprised to see, potentially double-digit negative returns for that more conservative defensive part of their portfolio. So that's probably where the conversation will anchor to for most clients is trying to get a better feel of how and why did this happen and what should expectations be going forward now that sort of historical relationship that people have grown accustomed to has been sort of flipped on its head.
What a thoughtful way to say that everything stunk.
Rubin's much more efficient with his words than I am.
Well, so I was actually going to ask Rubin. So, Phil said the clients are going to be asking what happened and why has this happened in the bond portfolio and what should we expect going forward? What are some of your thoughts on that, Rubin?
Yeah, I'm not sure that, if I'm sitting there presenting this to a client that they're going to immediately piece out before the meeting which asset classes did what. I think they're looking at one big number and it's changed and they want to know why. And I think it's our job as chief investment officers to describe the drivers of returns in their portfolio. And then, every client has a unique financial plan that requires a unique portfolio to deliver on that plan. And so what are those moving pieces within that portfolio? I think Phil did a great job of articulating that it was a brutal year almost across the board. And I think the one kind of maybe good learning lesson would be in stocks. People typically own stocks for the same reasons. They want growth in their portfolio, and all stocks kind of stunk, whether you were in the US or international or emerging. If you're not a stock picker, where your returns are actually driven by those companies, but instead, if you own diversified portfolios, it's hard to imagine that you had a year that you're excited about. But if you own bonds, it's actually a little bit different. I mean, I'm sure we'll talk about this later since bonds were kind of the big story of 2022, but depending on what type of bonds you owned, you likely had a different type of experience. So longer duration bonds that are more sensitive to interest rate moves, as Phil said, terrible years. On the shorter end, there's definitely some buffer and some ballast in those types of exposures if you do it the right way. And you see that while you might have had an unexpected year with short-term bonds down a little bit compared to some of the other asset classes, a client might look at that and be thrilled on how that.
What's interesting too to think about the surprises on the bond side is, in one way, there's sort of like a little bit of a parallel to the 08-09 crisis where, the word fixed income or bond, like you see that in a lot of fund names, and so people just assume they're all kind of the same thing. 08-09 was a credit surprise. People, a lot of people found out they had a lot more credit risk in their bond portfolio than they might have assumed. And this year, or last year, I should say, probably maybe more duration or interest rate sensitivity than they maybe assumed. And so it kind of speaks to that the universe of fixed income and different types of bond categories is pretty vast. And so your experience or your outcome might have varied significantly depending on how your bond portfolio was positioned.
I love that because you basically isolate that credit wasn't the big driver this time.
Right.
And it's another great way to reinforce to clients that it's really time horizon that matters. And if we haven't talked about that enough since 0809, because bonds have been kind of smooth on their way up and rates have just kind of slowly come down until obviously recently, it's a great time to remember, how bonds work and coach clients about what it means when a bond fund maybe has a negative year and what to expect going forward. It's very different than stocks. We have a lot of information about how bonds perform. And to me, this has just been a learning opportunity for many investors to think about how different asset classes perform and the types of information we have about that performance.
And I think too, like I think what I kind of really took to heart this year was longer drawdowns are much more painful, even if they're more shallow, than really quick ones that don't give you as much time to react. Like obviously, February, March 2020, that was a really painful time, but like I think most investors, if given the option, would prefer the really, large short drawdown than even a drawdown half the size that takes place over like an 18-month period, because that the sort of time dilation effect of like, days start to feel like weeks like months. It really kind of starts to interfere behaviorally with our perception of time and what long-term actually is.
And so I think that one of the things that I notice in internal communications, external communications, conversations with clients, friends, family, is just that, Phil, where there's almost the pandemic drop. There almost wasn't enough time to make a mistake. The longer a recession lasts, the more time you allow yourself to let doubt creep in. And I'm always of the opinion that a lot of investment success comes down to minimizing mistakes. You have to have a ton of discipline through these downturns. And I just put this on Twitter today, actually, that the average bear market lasts 18 months, average decline of 37% when there's a recession attached to it. Now, we haven't had a recession yet, and maybe we will, maybe we won't. But I think it's a useful expectation that as of this recording, we're 12 months in to a downturn, whether you're looking at that from the stock side or the bond side. And I know, at least in my conversations, that the more conservative the portfolio, the more concerned the client has been. And it's in large part because they have not seen bond declines like this in quite some time. Another common question that I got throughout the year, I'm kind of curious what you guys heard and what your response might be is, well, hey, if we know they're rising, shouldn't we just go to cash now that yields are higher? Now, the three of us all know that cash is an asset class like anything else, and there are going to be periods when it wins and periods when it loses. But given that interest rates have risen already, what do you guys think? Do you think the pain is already there? Do you think there's even a case for extending duration now that we've seen some of the uptick in rates? How are you talking about these things with bonds?
Yeah, I think we've all dealt with similar client inquiries throughout last year, which is whether it be cash or just like moving to all short duration bonds. And it's very intuitive in the sense of like, okay, well, if the 2-year yield is higher than the 10-year yield, why on earth would I take that duration risk for less yield? And so I think it's important to kind of reinforce this idea of what duration is, price sensitivity, and also, again, kind of point to not only are yields higher today, but if your assumption is a recession and some sort of prolonged or continuation of the bear market in stocks, and we get this sort of Fed pause at some point, and even maybe more of a reversal, that's going to be much more beneficial to your longer duration fixed income assets than your shorter duration. So the paper losses that you're seeing in kind of intermediate bond portfolios this year are just price adjustments based on a new environment. If you're to lock in those price losses and move everything to something that has a decent yield now, like cash or short-term bonds, but it's not going to move much if and when there is that, kind of reversal and stocks and bonds start behaving negatively correlated in a recession type scenario where, if inflation is your sort of kryptonite for bonds, then recessions are kind of your friend for bonds. And so I think we would certainly want to exercise caution on now shifting to a shorter duration from intermediate. If anything, it might be the time to do the opposite, but that's probably counterintuitive to how most people are thinking about it. Like the time to go short duration would have been, in hindsight, a year ago or year and a half ago.
And it goes without saying, I don't think any of us are ever recommending people tactically shift in response to what we think will happen or is about to happen. But, Rubin, I know you wrote about bonds throughout the year. Kind of curious to get your thoughts on this.
Did he ever?
I dedicated my entire blog to it. I like what you just said, Peter, about tactical shifts. So I don't do any tactical shifts. I don't have any opinions about the future of interest rates on bonds. And I think that's probably a delineation that an everyday investor needs to make, which is when I hear interest rates on the 6 o'clock news and they say rates are rising, what is that rate compared to what's the rate on my bonds? And those are two very different things. But if you connect, and I've heard people do this a lot this year, that rates are rising to that meaning that bonds are going to go down, you've made a huge error. And that's not how it works. And so rates, short-term rates, or Fed funds rates, those are very, very, very short-term, and bond rates are not determined by policy. Bond rates are determined by market participants, and so 10-year bonds might do whatever the heck they want. And when the Fed's doing something on the short end. And so anyway, it's very complicated, but I think that this word rates needs to be delineated. And I've seen too many times people connecting these two things like they're the same when they're not. So Peter, I loved what you said about the tactical shifts. I don't do any tactical shift, or if what I would call tactical, I don't do any tactical shifting because I don't have any opinions about where bond rates are going to go. Because bond rates are just the opposite of prices, and I don't forecast bond prices. So the question too, is it a time to shorten or lengthen duration? You would need to have sort of a forecast based on what you think bonds are going to do, which I don't. What I do have is I have my clients' financial plans. And as I said a little bit earlier, all of those plans have a portfolio that's been informed by them. To me, before any of 2022 occurred, the entire life of a client with us as advisors needs to be where their bond portfolio has an average duration that's shorter than their time horizon. Otherwise, you don't have enough time to make it up. And that's kind of a key takeaway. So as long as your bond duration, which is very similar, in high quality bonds, it's very similar to your average maturity. As long as that is shorter than your time horizon being when you need the money back, you should really be able to stomach this downturn. And it's our job to communicate that to clients. But one very unique thing, and Peter, you might want to chime in on this too, and Peter and Phil, I don't know what role this has played for you this year, but where I've seen changes I've made in total client portfolios has actually been not in the portfolios that we manage, but in some of the cash that clients have traditionally held in their bank accounts. So at the beginning of 2022, what you would earn on, say, a short-term treasury, like a 3-month treasury, would be paltry and very close to 0%. And throughout the year, that has ticked up. That's rates rising. That's the mortgage rates you felt. That's car loan rates and credit card rates. And that's also the rates rising affects the rates you can get on short-term treasuries. And so now yields on treasuries, depending on what day you look, they're in the 3% or the 4%. So there's a huge opportunity cost to someone that holds too much cash in a bank account. So I would say one change that maybe we've made, I'd hate to call it tactical, it's more strategic, is to say, look, clients, if you're holding too much cash in your bank account because it makes you feel good because you have a buffer, we'd like you at least know there's an opportunity cost these days that didn't exist a year ago. And there might be an opportunity for you to invest some of that in short-term treasuries, which are the risk-free asset. And as long as you don't need this money until the day that those treasuries mature, you can get a yield that's much more meaningful than it was a year ago.
Yeah, I would agree with that, Rubin, that I think of the portfolio, the cash that is within a portfolio is part of your investment portfolio. And then the cash that's held outside the portfolio, that 1 to 2 years worth of expenses or the cash buffer that you keep for any number of reasons. Yes, that I think, making the shift towards treasuries or other extremely short duration or ultra short duration type products just to earn a little bit of yield with minimal risk of price volatility, especially when you're buying a 3-month or a 6-month T-bill. I mean, you're very confident that you're going to get that money back at maturity, and that was easily trumping what you'd earn at the bank. In my opinion, what the banks have made it pretty clear that the demand that they have for deposits versus the supply of deposits that are there, they're not going to be paying very interesting interest rates. Terrible choice of words, but very interesting interest rates for quite some time there. As much as I do want to keep going down the bond rabbit hole, because I'm pretty sure the three of us could do that for another hour, we probably should have started with something like stocks, because I know the listeners are always more interested in the equity side of the market. It's always what's on the news. It's always what's in the paper. Because the three of us know each other very well, I do know that the three of us are all believers in varying degrees of value over growth in terms of a long-term position. It's been a long time since value has beaten growth. Either one of you, actually, Rubin, I want to start with you, because prior to being chief investment officer, you worked for a very well-known fund provider, Dimensional Fund Advisors, who many people who are value investors knew. So you've actually experienced it at the asset manager level as well as the independent in-client level. So talk a little bit about this year. I feel like that was a huge storyline, value outpacing growth for the first time in a while.
Oh, I'm not sure I have a great answer here, because I don't think about this that much. Stocks are so noisy, and it's so easy to extrapolate things. You're right. I have a belief that over long periods of time, that if you pay, say, a lower price, buy a handful of stocks for a lower price, let's say you're buying $1 of earnings and you pay a lower price for it, compared to $1 of earnings that you pay a high price for. So value stock compared to growth stocks. I have a belief that more people would rather own, great, successful, high-flying companies. And it's hard to convince someone to own struggling companies, right? Like who wants to work at a value company? And because of that, it makes sense to me, and it's intuitive, that there should be a premium embedded for people willing to buy the downtrodden stocks, the companies that aren't that great. And I think that connection isn't often made to people. People assume that if you buy these high flyers, the great companies in the world, that you should do better. When in reality, if you have to convince someone to choose one, people are going to want those nice looking growth stocks. And so there should be an embedded premium if you're willing to own value stocks. Otherwise, no one would buy them. And of course, if you diversify, so you remove some of the idiosyncratic risk, because remember, most companies, when they go bankrupt, at that point, they're a value stock, not a growth stock. So you want to mitigate that idiosyncratic risk. And as Peter said, having worked at Dimensional and Dimensional being affiliated with some of the top minds and Nobel Prize winners around what drives investment returns, there is a value premium. Historically, there are ways to capture that value premium in funds, which we also have seen over the last 40, 50 years. And it's my belief that stocks are really, really noisy. So I don't put clients in all value stocks. We basically own the global stock market and we overweight value stocks a little bit. And I expect that to do better than a market portfolio or a growth portfolio. But I don't really expect that except for over 15, 20, 25 years. So I really don't think about this stuff too much year to year. It was nice to see value have a rally this year, but I'm not going to set expectations that it's going to happen again next year. With stocks, I have no idea what's going to happen over the next few years.
No, so, yeah, well said, Ruben. Yeah, I mean, we're strategically overweight the value as well, but much in the similar sense that Ruben mentioned earlier, where we're not, 100% of our portfolio is not in value stocks. We have broad market exposure with that embedded tilt, and that's by design for the expectation, not the forecast. And there's a difference between the two, that over a long enough period of time, there will be some incremental returns there. But I think what we need to recognize and step back with is that for an equity investor, the biggest source of return for your portfolio long term will be the market itself. You hope for some incremental returns around the edges from whether it be value or size or profitability or other types of factor tilts, but those are not going to be the difference makers. And I think if the last call it 5 to 10 years has taught us anything, is to be very humble in our expectations for these premiums, and that they are not a straight line. They don't show up every year. We don't know when they're going to show up, and so. The growth cycle of the 2010s lasted way longer and was much greater magnitude than anyone would have expected, and I think it caused a lot of value investors, quote unquote, to sort of question their beliefs around the tilts that they might have had. And then I think we need to be mindful too to not be take a victory lap because there's been a really strong year and a half of value outperformance. That yes, it's felt good and it's helped buffer downside performance a little bit for our equity portfolios, but you don't want to continue to just extrapolate that'll continue next year and the following year. The expectation is that it will, But again, there's a reason we're not 100% in small cap values, because that's a very different looking portfolio than the market itself. And anytime you're looking different intentionally or not than the market, your performance is going to behave differently. And that's another consideration to keep in mind for investors when they're making these sort of factor tilts or expressing these factor bets, is that for better or for worse, you're going to behave and look different. And how different can you tolerate looking than the market, than your peers, before your behavioral biases creep in and potentially get in the way and cause the wrong decisions at the wrong time.
I might add that this is always kind of fascinated me, but these factor companies, we can use Dimensional as an example, fabulous company, and they're part of the value proposition is overweighting small stocks and value stocks in the long run to outperform a market portfolio. It's a fabulous story. There's evidence behind it. They have realized returns to tell it. I mean, fabulous company. But at the same time, Dimensional, one of the thought leaders associated with Dimensional is Gene Fama. And what's Gene Fama known for? Saying that prices are fair. So I always try to remind clients, some modest tilts to these premiums over time. If the premiums are, economically intuitive and we can capture them in live portfolios, historical evidence helps to show that, our expectation has met some reality over time. But also there's nothing wrong with growth stocks, right? Like prices are probably pretty fair. And so as I said earlier, it's just, I'm not that fascinated about this eggheady topic of quanti factors the way so many people are, because as Phil said, it's really not what drives outcomes for people in the long run. Most of the people I meet would be better off focused on, do I have the right amount of stocks and bonds? Is there a way I can make more money in my life so I can invest more in the market? And all these other things that peripherally matter, or matter a lot more. And the value tilt or small cap tilt, it's much more peripheral, and it's more like icing on the cake if you dial everything else in properly.
Well, there's no doubt something like efficient market hypothesis doesn't say that prices are necessarily right. It's mostly that we just can't tell if they're wrong, if they're undervalued, overvalued. Ultimately, I think for all of us, you try to take an evidence-based approach, because probabilistically, particularly over a long period of time, you're just trying to generate an outcome based on what is most likely. And with something like value, paying less for some sort of fundamental, whether it's book value or earnings or cash flow, there's a good theoretical framework for why that over time would add value. There's also empirical evidence that shows that the probabilities are higher over the long run. But year to year, for all of us who've been coaching people through periods where value hasn't done as well, anything can happen. And gosh, the market return alone, I think, Phil, it was you who said, the biggest driver of returns ultimately just going to be the market itself. We quote market stats all the time. All of us do, all of our colleagues do. And yet, the market return is pretty hard to earn if you keep making changes and if you meddle too much with the portfolio. Two things that you guys have both said and that I would totally agree with is that a lot of it comes back to the plan, and a lot of it comes back to what's the saving, what's the spending, what's the assumptions. I thought it'd be kind of interesting to give an inside look for those of us, whether they're watching us or listening to us, on some of the underlying returns that drive some of our financial planning models. So just to level set for anyone listening, watching, we have something called capital market assumptions. They're returns and standard deviations, which are just the variance of the returns around their average, as well as correlation, like how different or how are the movements between the different asset classes related. And so I know at Plain Corp, it's me and my colleagues on the investment committee. We don't have to get into that level of detail with the two of your guys' firms, but those capital market assumptions really make a big difference in financial planning outcomes. So for example, I know that if somebody has an 85% probability of success, meaning that all the things they want to do in their life, 85% of the time, they're not going to run out of money. 15% of the time, we'd probably have to make a tweak to the plan to make sure that they don't run out of money. I do know that even a 0.25% difference in return assumptions can lead to a vastly different probability of success. So I thought it'd be kind of fun just to kind of one by one go through how we set those capital market assumptions, and anything that you guys think is interesting in sharing about it. Rubin, let's go ahead and start with you.
Well, I'm probably an interesting case study because while I've worked in investments my whole career, But I've only been an advisor for a little bit over a year, and I'd never run a financial plan until I started this job. And what you just shared was very eye-opening to me. And my initial thought the first time I saw a financial plan and tinkered with the expected return of the portfolio was, geez, you can make this thing look like anything you want it to. And that's by just changing the rate of return the portfolio is going to get, because if there's a long enough time horizon, because of compounding, just vastly different outcomes from what Peter said, even just 0.25% of return. So what is dynamic and what investors should be aware of is how easy it is to make things pretty. And so it's very important that investors have a well-calibrated expected return for the portfolio they have, but also be aware that things are really noisy. We talked earlier, bonds are a little bit less noisy than stocks, but stocks are very, very noisy, especially if you have shorter time horizons. So when I think about financial planning inputs, the first thing I think about is conservatism, which is I do not want to overshoot this and set some expectations that are going to be wildly incorrect. So the way we do it at our firm, just for kind of brief perspective, is for stocks, we take a pretty historical perspective. Sure, when stocks are really low relative to their average, if you do a price to earnings ratio or something like that, it looks like the data over time says they're going to do a little bit better over the next, say, decade or whatever it might be. And if stocks are really, really expensive, then sure, you can look at the data and some of the takeaways can say, it's probably lower expected returns going forward. But trying to time that right, just look at the tech boom in the late 90s. It's really hard to say things are too expensive, I'm going to get out of stocks now. It's just never going to, the market doesn't care about you. It's not going to happen on your timeline, and you could be wrong for years. So for us, we kind of keep a pretty consistent historical average for stocks. We start there. For bonds, you have a lot of information. I said earlier, you can use the yield as your expected return, and as long as you have a long enough time horizon, the yield is a great proxy for expected return if you're using market-based funds. Again, for either stocks or bonds, if you use active management, more concentrated positions, you're allowing a manager to drive your returns as opposed to the market to drive your returns. So if you use active management, I have no idea how you're going to do. Because at that point, you have defaulted and let someone else hijack your outcomes. But low-cost market-based portfolios, which is what I prefer investors use, this is a pretty decent way to do it. Then we reduce that expected return by expense ratios, reduce it by advisory fees. We adjust for future approximate sort of blended portfolios the client might have. So if the client's 40 years old and they have a really high torque equity portfolio, they're probably not going to have that when they're 75. And so I need to taper down my expectations. I can't just use the high torque equity exposure portfolio expected return for their whole life. So we take accordance that. And then we use last thing we do is a time horizon discount. If someone has a pretty short time horizon, maybe it's because we're focusing on a specific liability, or maybe it's because they're old, we'll take another discount for that. And because we have Peter, you articulated this really, really well earlier, I think, but it's our expectation meeting our reality has a lower probability of occurring. So we take a little discount there, and then finally we add one last layer of just conservatism discount. So we take this whole aggregate expected return and we keep cutting into it until we get to a final expected return. And then alongside that, we show our clients the rolling 10 and 20-year returns for a portfolio like that, just to kind of set expectations. And that final net return that we're going to use in the inputs tends to be and look in that distribution very, very conservative. And that's our intent. The nice thing about financial plans is hopefully you update them every year at least. So you get to, if you have a good outcome, you get to input higher asset values the next time and continue to hopefully improve the probability of a successful outcome for the investor.
And Phil, before you jump in, I was just going to comment on that last piece that Rubin said, because you update them annually.
I think that's the key.
I want to point that out specifically for people who are listening, who are not like investment wonks like we are. There is no agreed upon equity risk premium. There's no agreed upon, you can read academic research on this stuff until you're blue in the face. But the ability to get inputs from the client on a regular basis allows you to be a little bit more wrong. Because one of the things is you really have to get this stuff right if you're building a plan once and it's static. But if it's this living, breathing thing, it definitely gives you a little bit more flexibility in those assumptions that you make. So I love that you brought that up, Rubin. Phil, I'll let you jump in now. Tell us what you think of it all.
Yeah, I was going to say, like the the key thing that Rubin hit on towards the end there was just that, like, a financial plan is a PDF or a printed out document you hand someone. Financial planning is an ongoing dynamic exercise. And so I look at capital market, assumptions as like it's a necessary exercise that is inherently flawed, and there is no perfect way to do it. And I think often we pay too much attention to like the expected return number and not enough to the standard deviation of those expected returns. And also the fact that they can change dramatically. Like when we have let's say we have a lower expected return because of valuations or higher because of lower valuations, that doesn't mean that whether it's a 10-year expectation or whatever, that it's going to move there in a straight line. You could have really, really low expected returns and have a phenomenal year in markets and vice versa. And so there's a ton of noise in the short term, and I think there's also like a little bit of a delicate balance to strike between, because more usually financial plans are going to be 20, 30, 40, or longer years in terms of their expectancy. You can't base that long of a financial plan off of a 10-year horizon of expected returns. And so I think there needs to be some sort of balance of like being honest about the state of the world in terms of inflation and interest rates and valuations, and having that have some influence on expected returns, but kind of blending that with a much longer term assumption that's more anchored in just kind of the history of what markets have delivered. So, it's an exercise fraught with imprecision, but we have to do it because those plans need assumptions. But again, it kind of gets back to, you want to test those plans under a variety of different assumptions, because there's also the risk of being too conservative with expected returns as well. And that clients maybe aren't spending as much as they could be spending in retirement or other things. So it is always tricky. We update ours quarterly, and so again, it can have big impacts on plans, and just like the difference in expected returns from beginning of last year to now is pretty meaningful, especially for the bond piece. And so it's just it's an ongoing conversation that advisors need to be having with clients. Keep updating the plan, keep updating the assumptions, but don't place too much faith in their accuracy either.
What Phil ended on there is probably worth everybody knowing, which is that if you haven't updated your financial planning assumptions or capital market expectations since last year, you're missing out, because bond yields being so much higher now has dramatically changed the landscape of expected returns in bonds. And so while you've taken a price hit likely, and so the account value in your bonds might be lower, the expected return going forward is much higher. That's a line or a little pithy comment people love saying when prices go down on assets, that, well, the expected returns are higher going forward. But in bonds, it's incredibly true if you're using short-term high quality or intermediate short-term high quality bonds, because we have so much information about their expected return. And then one other brief thing I just want to say that Phil mentioned is that you can have expectations that don't match reality, and that's because I wrote about this in my piece last week on the blog, that returns come from just two things: expected returns plus unexpected returns. And in the short term, unexpected returns drive everything, which are what are the random occurrences that are going to happen in 2023 that we have no idea about. And so that's the stuff that's going to drive prices in the short term. So over long periods, hopefully those things kind of net each other out, and that's why we use expected returns, and maybe long-term historical averages seem appropriate for something like stocks. But that's why all of us kind of say in a one-year period, I have no idea, because over that period, it's going to be all about unexpected returns, and I don't know what's going to happen this year.
And I'm not surprised, just because I know you both, that you guys philosophically sound the same to me. I hear the nuances on how you're different, and I think my philosophy is in a similar place. Just to kind of round out the differences that we have, is that we really anchor our capital market assumptions to long-term real returns of global stocks and bonds. The long-term real return of global stocks is just under 7%. The long-term real return on bonds is 1%. We do this because then we don't have to forecast inflation. One less thing that we have to do, because these models do have to forecast inflation. So that sort of removes one more assumption that, like we're all saying, we can't actually predict the future. And, I think one of the nuances when I talk to other people about this that you guys have raised is we all see that valuations are high right now in equity markets. And so the probability of returns trailing long-term averages over the next 10 years is a little higher than it has been in the past. That said, I'll say we don't make an adjustment because we assume, well, if we're running 1,000 runs in the model, some of them will account for that, and returns will be poor in those first 10 years. This is all to say there is not a right and wrong way to do it. I do think it's interesting, though, that we all have a general same belief system. And Rubin, to your point, very early on within this particular area of the conversation is you're just trying to not be wildly incorrect. I think if we're all going for precision, that doesn't really exist in this situation. I don't know if there's anything that you guys see happen in the broader profession or marketplace that makes you a little uncomfortable, or that you really have tried to embrace in your process at all that you feel like sharing?
One thing that Phil mentioned is that, to your point about sort of not being wildly wrong, is we certainly don't want to overshoot it and have clients be frustrated and surprised to the downside. But as Phil said, it's our job to also enable clients to live nourishing lives, and what they've shared with us that they want to experience. And our job as their allocator of their capital, their hard-earned money, to deliver on that. And we don't want to undershoot it either too much. So I love the way Phil ended that, which is like, we got to get somewhere in the middle. We can't be wildly wrong to the downside, but we're not doing our job if we're too conservative. So I really love that. What I see as what makes me cringe about expectations, I've said this a few times, is just people think they know stuff and they don't know stuff. Nobody knows anything about what's going to happen this year. So when you hear pundits and whatever talk about their expectations for this year, you just tune it out. If it's stocks, if it's bonds, you have a little bit more information. So it depends what asset class, but things that really get to me are when people use the word optimize. We're going to optimize this portfolio for this screen. Like, that's not a great word. That tells you don't understand unexpected returns. If you're optimizing, you don't get it. Big swings in equity expectations based on what's happened. So if someone says, well, I think stocks are going to do 30% for the next 4 years because of X, Y, Z. Like, what if you're wrong? I mean, trying to get that timing right is really wrong. So I think you always probably want to be somewhat close to the long-term average within reason. As I said, I will even, as someone who just believes prices are pretty fair all the time, I'll even give in that when valuations are really low, sure, expected returns are probably a little higher. When valuations are really high, expected returns are probably a little lower. But I really try to not do too much of that information. And so the last thing I would say is people often get wrong using expected returns when they use active management. You have to remember what do you think moves prices? And if you want your returns to come from a manager, then you can't use long-term averages of indexes because your returns are going to be driven by the manager. That person has hijacked the portfolio decisions. If you think returns come from the market and you own something that looks like the market, then it's reasonable, everything we've been talking about.
Unless they're a closet index, then just deduct 1% from the market return, and then there's your assumption. But I things that make me cringe a little bit. I would say, just like you guys all experience this as well. Is late December, early January, you get the inbox full of market outlooks and playbooks for 2023, and just like all these long form pieces written by very smart people, but that try to imply some sort of certainty around a very short term time frame. And so again, those can be fine for entertainment purposes, but this notion that new year, new me, or new year, new portfolio, I think is just really silly. Like, why should your investment philosophy change because of the turning of the calendar? I think that's something that people too often do. Okay, like, it's January 1st. What should I be changing in my portfolio? Like, usually the answer is nothing. And one example that I won't name the name, but it was funny that the Outlook I opened, like, the tagline was 2023, keep it simple. The Outlook was 73 pages long. What is the simple philosophy for 2023 that you're going to opine on for 73 pages?
It's amazing, too, that somehow every year people's opinion is that whatever my company sells, it's a great time to be in it, right? I mean, people have agendas in this industry, and the nice thing I think about working with, say, an independent advisor is you want to take advice from people who don't have a pony in the show, right? And who don't get paid when their product gets sold. And so most of the times that you see these expectations for the year, predictions, prognostications over a 1 year time horizon, if you believe them, I typically they also have a fund you can buy that helps you get there.
So totally with you guys on both of those. We've been kind of on the wonky side throughout this conversation. I thought we might zoom out a little and give listeners and viewers a little bit of insight into our roles as Chief Investment Officer. What is something that you guys think about our role that most people wouldn't understand or would be surprised by?
I think for me, it's there's a difference between investments and investing. Investing is an exercise, and I think people probably assume our attention is predominantly focused on the former, which is selecting investments, building asset allocations, and certainly yes, it's a big part of what we do, and our teams support us with. But I think a large part is more on like helping curate a successful investment experience for the clients that work with us. Because again, we can quibble about like what the best portfolio construction looks like, but the best portfolio, essentially, like Cliff Asness says, is the one that somebody can stick with. And investments can always be very hard to stick with, especially for someone who's more of a novice that isn't in a professional seat like ours, that doesn't have the benefit of understanding market history to the degree that we do, and they can get scared out of portfolios. So I think it's very much the communication side of things, both written content, support for the advisors at our respective firms, and getting in front of clients as well, and just helping them navigate this very, very long-term exercise that again, as Rubin mentioned earlier, like we're trying to enable people. I love the words you use, enable them to live a nourishing life. I hope you've trademarked that. But like that's really what it's all about. Like we're trying to help people achieve what's most important to them. But that's in most cases for people, that's a very long time span. And so the slightest, misstep can have really long-term ramifications. We've seen it before in our own history, is the people that, cashed out in early 2009 and missed the upswing. Like those are irreversible mistakes. And so I think the role of CIO is just as much, if not more, about the experience of investing as it is about the investments themselves.
I think in my experience, what people most don't understand is that I'm not an economist. People ask me all the time about the economy, and I typically have no opinions. And I think that, just clients think that I have forecasts or
maybe
some special
insights. Because you wear bow ties all the time.
And so just to delineate that, like, the economy and your investment portfolio are very different. And you don't need to be an economist to have a great investment experience, or listen to economists to have a great investment experience. It's my belief, and I think it's a belief of Peter and Phil, which is that prices and markets do a pretty good job of setting themselves, because buyers and sellers are meeting together based on all this information they're hearing about corporate earnings and the economy, and all these things get baked into the price. So I think clients often get surprised when they ask me about what I think the Fed's going to do, or opinions about the Fed, and I don't really have them. I don't really think about it that much.
Well, that's interesting, Rubin, because I have opinions, but I don't invest based on them. And so sometimes I'll tell clients, well, here's the range of outcomes. Here's what I think, but I'm not changing the portfolio, and here's why. And both of you are saying, I'm hearing you sort of echo what Phil said on the communication side. A lot of what we do is communicate and help guide people towards the right decision, which is often do nothing. And I also think, Phil, what you said about how people assume we're over here just doing due diligence all day long. And I will admit that there is a lot of funds that get reviewed over the course of the year, but I think a lot of our people think our job is to say yes to all those. Whereas in fact, I find that my job is to say no to new things, to say no 10,000 times.
More, you're acting more as bouncer and kind of keeping out.
That's the famous Josh Brown analogy is, you're the bouncer, keep all the bad stuff out of there that you don't want in. You're only supposed to let a little in.
And like the stuff that gets said yes to is like the tip of the iceberg above the water and everything else below. So,
well, I think people, maybe we've cleared up to all the people who are confused about what we do with our time every day. Now we've made that all clear. One last question I want to ask you guys before we close out. I did a survey of listeners recently and of my newsletter recently. And for those people who don't use a financial advisor, the number one reason was cost. I've done whole episodes on the topic, so I'm going to try to stay out of this unless one of you guys really trigger me into chiming in as well. But what would you tell people that do it themselves in order to save the proverbial 1% or whatever the percentage fee is?
I don't want to use a specific number because fees differ from firm to firm. Fees differ by clients, et cetera. Like firms charge differently for what they provide. So, but if someone's doing it themselves, first is there's a recognition that there is a small subset of people that truly are able to do that on their own, and are likely maybe better off just, if they've got the time and energy and interest, they could probably save some money and do it on their own. That, to me, it's like, how much time do you want to be spending on this stuff, and doing an inventory of all of the different types of things that you need to be doing, not just once, but on an ongoing basis across your entire financial picture, not just your portfolio. And when you start to list out those things, I would argue that most people do not have the experience or energy or interest in doing those things relative to delegating it to a professional to do it on their behalf at a fair cost. And so I think it's really just understanding that what you're paying for is more than just building a portfolio and trading it and rebalancing it. Like that's the sort of vehicle that makes the car run. But there's so much more beyond that. And so I think once you kind of sit down with someone and walk them through all the different disciplines within financial planning, all the different sort of checklist items that an advisor might, review with them on an annual basis or more frequently perhaps, they start to like open up a little bit and realize, okay, this is much bigger than maybe I thought it was, and I'd much rather be spending my time doing things that I enjoy, being with my family, focusing on my work, etc. So, like it's in many cases not a cheap relationship or inexpensive relationship, but I would say that for most people, the value is far in excess of the cost.
That's good. Phil said time, energy, and interest. And I might even say time, energy, and disinterest. Like this shouldn't be exciting to engineer your finances and your investments properly. It's not supposed to be something that you're in there all the time about. And so people that are overly like excited about running their own money, I assume those are the people that probably tinker too much. And
I have to remind myself daily that the stuff that I find really interesting in investing is the equivalent of watching paint dry for 99%.
And you're a bouncer, right? We're talking about the bouncers. You play the role of a bouncer, whereas maybe a lot of people get excited by the party. And so if they're doing it on their own and don't have the knowledge base that you have, that typically the more you play with your investments, the worse off outcomes are, because you're going to start to time things wrong and be a human. And that's a terrible thing to be when you're trying to invest properly. So I might say, I'll tell a quick story, is I had, when I joined this firm, Prospective Wealth Partners, a buddy of mine from business school reached out about potentially becoming a client. And our process is we say, look, we don't assume to know that we're a good fit for you, that you're a good fit for us. So let us kind of look at some of your stuff and we'll build out what we think a plan is going to look like and see if there's an opportunity to add value to your life. And he uploaded all his documents, basically his financial life. And my partner and I looked at it and we were like, he shouldn't hire us. He had everything dialed in well. He had great portfolios, low-cost index funds, market-based portfolio, globally diversified, tax efficient. He was maxing out all the right accounts. And it wasn't even that simple of a thing. He had a SEP IRA. I mean, he had rather nuanced things that you would typically see. The rest of my experience as an advisor, I see no one typically get right. But he had everything dialed in. And so our response to him was, you probably shouldn't hire us. And I think about that moment all the time because I'm not sure I necessarily thought that that's what advisors did. But I know that, us and advisors of high integrity, we're not going to try to convince someone to be a client if they don't need to hire us. To Phil's point, more often what I see, almost everyone else that I've seen, there's some way for us to claw back our fee, provide meaningful value to this family that they haven't thought about. And sometimes it's rather simple. They're not maxing out various accounts. They're not being tax efficient. They're using kind of silly, expensive funds. And sometimes it's a little more strategic because maybe they own businesses or whatever it might be. But I've rarely seen a chance where I think it doesn't make sense to at least explore working with an advisor, but I have seen it. And I think you want to be around people who are going to tell you that if you happen to be the DIY investor that really doesn't need help.
And if you're that do-it-yourself investor, I do, most of my experience is that you don't really know how you're performing, and that can be okay. But on the investment side, to me, one of the biggest value adds is the avoidance of errors, because all it takes is avoiding one big mistake to pay for a lifetime of fees. Now, in reality, all our firms are also doing financial planning. There's tax planning, there's estate planning, there's capital allocation questions. There's all these different things that really bundle up into an advisory fee. But ultimately, look, I can mow my grass myself, but it looks better when a professional does it. And now I have more time and I literally never think about it. I even had like little equipment going into this fall. I'd gotten rid of the mower a long time ago, but I had fertilizing equipment. I had leaf blowers. I had all this stuff to rake leaves. I don't do any of it anymore. And I had told my wife the other day, I am never raking a leaf again in my life, ever. There was even a part where I did enjoy it. I liked going outside. I'd listen to music, listen to podcasts, rake the leaves, I like tasks.
Peter had the big pile, and then he went and jumped in it himself because he's like a little kid.
Well, see, this way now I can pay someone to do it and jump in the pile with my kids. So, I think like anything, when you have a coach, when you have a professional helping you, the outcome is typically better. Guys, I really appreciate this. I know we got pretty wonky at some times, but for those listening and watching us, where can they find you guys?
I'll go first. So you can find me a few places. I have an investing blog called Bips and Pieces, BPS and Pieces.com. On Twitter at Bips and Pieces, and then I write regularly for the Savant Wealth blog as well. So that's savantwealth.com.
I have a blog as well called Fortunes and Frictions. Peter, do you want to say anything about that?
Yeah, I always tell people I think Rubin had the best new blog of 2022. So
I was the first person to say that. I knew Rubin was a good writer before it was cool to know that. So
the running joke is I am Rubin's official PR agent. But yeah, Rubin, tell the people where to find it.
Yeah, thank you. Yeah, so that's fortunesandfrictions.com, and then I am on Twitter, Rubin J Miller, and also I publish on LinkedIn, so you can friend me there, and I look forward to connecting.
Well, and for everybody listening, I'll obviously include all the information for these guys at thelongterminvestor.com in the show notes. Be sure to like and subscribe if you're watching us on YouTube. Leave us comments on Apple Podcasts, Spotify, wherever you're listening to podcasts. Not only does that make it easier for other people to find the show, but it helps me get feedback on the type of guests you want to hear from next. Again, guys, thanks for joining me. And until next time, to long-term investing.